Hello and welcome back to the channel. If I sound a little bit nasally, it's because I have a bit of a cold this week, so apologies in advance. Recently I've become very interested in options trading, more specifically selling premiums on options. Now, I'm not a big component of day trading or swing trading. I'm rather in the realm of buy depressed valuation stocks and ride them out for multi-baggers over a few years. I'm not really a chart analysis type of guy. But as we all know, the stock market is extremely volatile, and I've always wondered how could I personally benefit from that volatility. And I know there is a small percentile of people that are very good at day trading or swing trading, but as I mentioned, it's not for me, and also I don't really like that lifestyle. The more I learned about selling premium on options, I realized this was a method that can actually turn that volatility into an advantage to me as opposed to a disadvantage. In this video, I'm going to cover exactly what I'm doing to earn a little bit of income on the side, and I'm actually going to show you two trades that I've placed this week. So this video will not be explaining exactly what an option is or the nuance of a option. I think there's much better videos out there already which you can watch and review so you have a basic understanding of an option. Firstly, what are we not doing? We are not buying options. What we are actually doing is selling the premium on options through a method called covered calls or cash secured puts. So these are the two main methods that I've been using to earn some income on a weekly and monthly basis, and I will cover both of those examples in this video. What we're trying to achieve is, as I mentioned, benefit from the volatility. Secondly, this is not some outrageous strategy where you will make like 100% on a monthly basis. My real aim is just to earn 5% on my capital within a month, and that's already quite high. I would say 2% to 5% is the range that I generally try to operate in. Some things to keep in mind is that each position has to be deep value. What I mean by deep value is that you're happy to own that underlying stock, because these methods actually involve maybe you already owning the underlying stock or you being assigned, which basically means that you will be buying the underlying stock at a certain price. And secondly, we need to accept downtime. So we're really trying to capture the volatility, and sometimes the markets are flat, they're not volatile. So this is not something that is going to work every month. So now let's actually go over an example of what is a cash secured put option. So the basic premise of a cash secured put option is that you're willing to buy a stock at a certain level. For example, you're willing to buy the stock Transocean for $4 on the 6th of January. Now the risk associated here is that on the 6th of January, the stock may be trading at $3.50. So therefore you're actually buying at a higher price than what the market deems its current value. This is why it's very important to only go with the strategy if you have a thesis on the underlying stock and you're bullish on that thesis, i.e. Deep value, because you don't really care if the stock is at $3.50 because you expect the stock in the future to be at $10. Yeah, so that's why it's very important. But basically for this risk, that premium is our income. Now let's say the stock on the 6th of January actually trades at $4.50. Now in this case, the seller's not going to assign you the stock for $4, right? So you're just going to get back your cash that you secured for the given scenario that the stock was trading at 4. But because it's trading higher, the seller isn't going to sell you a stock at a lower price than what the market deems its value. So you will just take the premium, and that will be that, and your cash will be freed up for your next trade. Now let's cover an actual real life example. So this is a real life example of a cash secured put that I placed yesterday. The stock is Eco Petrol and its current price was $9.95. So here I'm writing the option. I'm not buying it, I'm writing the option. So what I'm saying here is that I will buy this stock Eco Petrol on the 20th of January at $10 per share. And for this, the seller will pay me a premium of 50 cents per share. Now it's important to remember that options trade in hundreds, so you always have to buy a minimum of 100 shares. So in this example, let's say I bought one contract, which is 100 shares. And for each one of those shares, I'm getting 50 cents. So my total income for this trade would be $50. Now, of course, if you bump that up to 10 contract, then you, of course, it's 500. But this is a cash secured put. So we actually need to put up the cash up front as a guarantee that we will buy the stock at $10 on the 20th of January. So I actually have to put up, if I'm buying one contract, $950. So firstly, if this stock trades under $10, I'm gonna have to buy it for $10, which I'm perfectly happy to do because I like this stock. I want to actually own this stock at $10. You know, I already own some of this stock at $10. This is just my trading account. So it's very important that you're happy to own that stock at that price. But also notice, because you're actually getting that 50 cents per share, your break even is actually lower. So your actual break even, including like the premium you get, you're actually buying the stock for $9.50. Now, if this stock trades above $10 on the 20th of Jan, which I believe it will, all that happens is I get my 950 USD back, the one that I put as a guarantee or a deposit, let's say, and I get to keep the premium. So in this trade, I made $50, and that would be my income trade for the month or the week. Basically, of course, you can do 10 of these trades, 20 of these trades, depending on how much capital you have, how much you want to actually do. But this is the basis of a cash secured put. Now, let's say the stock trades at $9.80 on the 20th of January. Okay, so what happens is you'll actually be assigned 100 shares of this stock, and you will be paying $950 for those shares. So you're happy to own them and you expect it to go up, so it's not really a problem. But you can actually also use this as a benefit to do the exact opposite. You can now sell what we call is a covered call. So the basic premise of a covered call is that you're willing to sell a certain amount of shares on a certain date at a certain price. So in this example, 100 shares of Eco Petrol, we're willing to sell those for $12.50 on the 17th of February, and we receive a premium of 35 cents per contract. So in total of 100 contracts, we're actually getting $35. Now, the very unique aspect here is that not only do we get the premium, we also get the delta between how much we bought the shares and how much we're selling the shares. So for example, let's say this someone takes this contract and we get our 35 premium, and then the stock trades at $13. Well, the most we can make is only the delta between $9.50. Remember, that's how much we bought the shares for, or what assigned the shares in our previous example, and the delta between that and $12.50. So if this trade was to complete, and let's say on the 17th of February, EcoPetrol traded at $13, our maximum profit we would be getting would actually be 562 USD, because that's the delta between 950 and 1250. So it's the capital gains that we get. So there you have it. That is the nooks and crannies of the strategy I'm using to take advantage of the volatility in the clinical sectors I'm in. Now, I know this isn't fancy and it's not a lot of money, you know, but for me it's good. I just want to earn a little bit of income on a weekly or monthly basis, and it keeps me busy, and I really like this strategy. I think it's low risk, low maintenance, and I just like it, I guess. These are two trades I put on this week that netted me around 300 USD, which I'm quite happy with. And you can check the prices of the stocks. Most likely, I don't think I'll get assigned any. If I do, that's perfectly fine. But yeah, thank you.